Hi, everyone. I'm Rosemarie Miller here with Rohit Kulkarni, the managing director at Roth Capital Partners, joining us to tell us about the earnings reaction for Alphabet stock.
Thanks for having me, Rosemary.
Absolutely. So it looks like investors are focusing on Google advertising revenue, which came in a little below expectations, although overall sales beat. Is that an overreaction or are they onto something?
Um, it's never an overreaction, to be perfectly honest. But having said that, the expectations were for a beat on ad revenues and to some extent a little bit of inline expectations for cloud. What we got was exactly the opposite. We got a beat on cloud, which is much smaller part of the business, and a miss on ad revenues, which drives a lot of profits. So that created a mixed kind of confusion amongst investors, and the narrative that could start to seep in, which is quite scary to be honest for Google, is search losing market share to say social media, to say TikTok, or some other emerging places to advertise. So that's the narrative that is much more scarier. If it starts to seep in, then Google shares could stay weak for some time.
So the Alphabet report seems to have depressed other stocks that rely on internet advertising. Is this an industry-wide issue?
Um, we will know a better answer to that after Amazon and Facebook report later this week. But until then, I think the general market opinion would be that yeah, advertising has recovered, but it isn't as strong as one would have expected it to be. So that would pull down smaller players even more, given the way advertising dollars tend to trickle down from first they go to Google, they go to Facebook, they go to Amazon, and then they trickle down to smaller players like say a Snapchat or Pinterest and so on and so forth. So I feel that's advertising is strong, has recovered as compared to what it was probably earlier in 23, but it isn't. We are not completely out of the woods. That's what Google seems to be saying.
So what key financial metrics stood out in Google's earnings report and why are they significant?
Um, Again, Google does provide a lot of financial metrics. I think I'll just run through what were the key positives here, and then we'll go into a couple of negatives and a couple of kind of neutrals or non-events as such. The key positive in here is acceleration in cloud. Cloud revenues accelerated. That's a very clean positive. That provides more support to the hypothesis that AI is helping cloud revenues, and that is something that would be a long-term positive. So that's the first positive. The second positive, in my opinion, is YouTube revenues also accelerated and came above expectations. So that's probably driven by what Google is doing with NFL, with subscriptions, and many other things around YouTube, with shorts, the small vertical videos, and so on and so forth. So those are the two big positives. Now come the negatives. Search, which is obviously the biggest driver of profits for Google, that came in slightly below expectations. So if search is going to be soft, then you start to think about, hey, is this because of AI? I'm sure you have seen some chat bots or some search generative experience on top of Google search. So that creates a little bit of consumer friction, and so we don't know if that draws away dollars from Google. So that's search being one big negative. The second equally big negative is profitability. Google is probably behind the curve as far as kind of the efficiency memo probably hasn't reached Google. I would put it that way. Think of what Facebook did last year. Think of what Amazon did last year. They were very proactive in right sizing their cost basis. So this year they are setting themselves up for significant profits. That's why people have greater confidence on what their profits could look like. Google, we don't know that yet. So that's the second big negative, that they had a miss on margins, and the CEO commentary, the CFO commentary was such that they'll probably continue to invest. So the margins are not going to inflect to the positive. So those are the two positives, two negatives, and kind of an unknown in all of this is Google does seem to say that they are going to spend a lot more in AI. How does that manifest into AI returns is still TBD in my book. So again, those are the metrics. Again, Google does throw a lot of data at you. It's a large company, so we are still kind of digesting all of that.
And speaking of AI, is Google trailing competitors like Microsoft?
That's the trillion-dollar question, right? In my opinion, they are playing catch up. They are playing catch up very fast. Microsoft clearly has positioned themselves as the go-to place, both from an enterprise AI standpoint as well as cloud AI standpoint. Microsoft has succeeded, and they have succeeded both with share of mind as well as share of wallet when it comes to AI revenues on the cloud and AI revenues on the enterprise. And that's primarily driven by the relationship with OpenAI. Having said that, Google, in my opinion, has been the godfather of AI even before OpenAI came along. But over the last 12 to 18 months, Google has been caught flat footed in a way that how do you commercialize certain AI research that they have been doing for so many years? Most of the commercialization, if you think about what Google does, is through search, and most of their AI efforts were inside search. So, how do you unpack AI in a way that you can commercialize it on a much more wider surface area? And that's what they are doing right now. They're taking all the right steps, but they're probably, I would say, 6, maybe 9 months behind Microsoft to be able to figure out that yes, they can play catch up. They are a leader in AI, and they can still be the gateway to internet as they have always been over the last 15 years.
This has been incredibly insightful. Thank you so much for joining me today, Rohit.
Okay, thank you so much. Thanks for having me.
Absolutely.